The views expressed on this podcast are those of the participants, not of Reuters News.
And everyone on Wall Street, and it's the same in the City of London, it's the same in Frankfurt, is saying our trading businesses are now financing businesses. Who are you financing? When was the last time that we went 10 years without a big hedge fund exploding? I don't remember that ever happening. So I don't really get that whole thing. It's more durable on a quarter-to-quarter basis, obviously. It's a higher returning activity potentially, but it doesn't make me feel great about the state of the system, if you know what I mean.
The Trump administration's enmity for economic orthodoxy seems to be cause for dismay everywhere except Wall Street, and even then, only below the C-suite.
It almost sounds like it could be a poem, Jonathan. A strange one to watch.
Starting off with my Wall Street Zen koans.
Like a haiku of some kind. But yes, a strange one. Jamie Dimon and some of the other bosses of the Wall Street banks, which we've seen earnings of in the past week, have really been talking up like quite a bad situation, like that how many economic threats are on the horizon. But at the same time, they're releasing results that essentially are looks like the banks are firing on all cylinders. So this kind of gap between the gloom and boom is the focus of this week's Views Room. It's Amy.
And it's Jonathan, and this is the Views Room, the weekly podcast where we dive into the knottiest topics in business, economics, and finance. And there is an oddball knot here. We have the KBW index of big bank stocks. It's up roughly 28% in the past year. It's way outpacing the S&P 500 index. We've seen JP Morgan, Bank of America, Citigroup, and so on come out with results that look pretty decent. We've had a lot of worry in the Trump administration about, are we going to see deals finally allowed again? Oh, maybe not. Depends on how antitrust looks. We've seen all of this sturm and drang around tariffs, especially kind of throwing everybody off kilter. And yet you've seen the trading boom kind of more or less continuing on, and M&A now is really starting to come back in a big way. You basically seen Goldman come out last week, and they were like, M&A is doing great, we're back.
Yeah, so Jonathan, how do you square this circle? How do you square what they're saying with the reality of what they're actually doing in terms of their actual results, right? Because I mean, I guess I could understand why, you underpromise, overdeliver, all of those types of things. But that doesn't seem to be what they're saying. I mean, Jamie Dimon is practically saying the sky is falling.
Right. Yeah. I think the line is credit is a bad investment now or something like that. I mean, even as JP Morgan tries to dive into private credit and all these other areas where the banks have been falling behind in terms of giving money to massively over-leveraged private equity plays. So there is a certain element where you can look at it and just say, oh, is everybody talking out of both sides of their mouths? But you sort of understand it at a top level, right? It's almost like the kind of retail trader stock boom that we've seen over the past few years. There is all these elements that really do set up for a situation that you would be worried about, right? We've been taught for decades, trade barriers just make everybody in the world poorer, reduce the terms of trade, make domestic economies kind of struggle. And yet you've seen a ton of new tariffs being brought on by the Trump administration, which seems to be back to turning the screws again every day. And yet stocks have now kind of shrugged off a lot of this stuff. We've seen some of the tech leaders that really hold up the U.S. stock market really, really continue to excel, especially NVIDIA and so on. We see private equity return to deal making. We see a bunch of signs that everything is just kind of copacetic in a way, which, again, like you say, it feels a little tough to put these things next to each other. And maybe it is one of those things where the older bankers who are up in the C-suite are kind of tied to their view of economic orthodoxy, even as the world changes around them. Or maybe it's marketing. Maybe it's, oh, the world is such a dangerous place and yet we're doing well. You should really come and bank with Goldman.
I mean, I think I feel like our guests today will have quite an interesting view on this. So we've got Stephen Gandel, Breaking Views Wall Street columnist in New York, and Liam Proud, our European bank watcher. And he is also an associate editor at Breaking Views in Europe. So welcome, Stephen and Liam.
Hello. Great to be here.
So I see, Stephen, I think we probably should start with you because you're the one who has been watching these Wall Street results as they have come in. I mean, can you kind of talk us through what exactly is going right, what's going wrong, and then a little bit maybe about what as Jonathan said, what the C-suite is saying about all of this.
So, there are two sides of the large banks business these days, these mega banks. Some of it's propelled by Wall Street and some of it's propelled by Main Street. And Wall Street and Main Street, generally move together, but they don't always move together. And right now, the Wall Street side of the business is pretty good because the Wall Street side of the business does well during volatility. Now, the Main Street part of the business is still doing pretty good. People are spending. And companies are still the labor market's still pretty strong, but the juice recently has been from the Wall Street side of the business, and that's the trading, and also just recently the big surprise this quarter was that M&A and investment banking in general, those fees are coming back. And so that combined's made a pretty good quarter this past quarter for Wall Street and a pretty good first half of the year.
Right. I think, Stephen, you and I were chatting a little bit when results were coming out last week, and you framed it in what I thought was an interesting way, which is this quarter, like everybody is starting to look a little more like Goldman, which I found really curious because I feel like the pattern in banks, at least in the US, has been a lot of arguing like, oh, we're not so tied to the kind of vagaries of all of these more volatile businesses, which you kind of think of the Wall Street side as being, right? Like it really depends on just how stocks are doing, how credit markets are doing, et cetera, et cetera. But it's, kind of a shift over to like wealth management or like kind of steadier parts of the retail business and so on. So I was wondering if you could like unpack that a little bit, right? Because there's obviously still like just big differences in business model between Goldman and like the Main Street banks like Bank of America or Citi, right?
Or even Morgan Stanley. I mean, not
Right.
as big, but so investors are supposed to be long-term thinking, right? They're supposed to like businesses that are durable over the long period, but reality, they're not. A lot of investors, at least, right? So a lot of investors see this boom coming or expect this because the bankers have been talking about pipelines and they've seen the trading be pretty dependable. So investors are want to get in on this boom in investment banking and a boom in M&A. And the way you do that is you buy the banks that are more levered or more connected to that business. And Goldman is one of them. And so Goldman shares have kind of outperformed everyone else because investors think they're going to get, and they've been right so far, they'll get a good portion of that rebound in Wall Street banking business. And so in the same sense, people want to say, hey, we're going to get part of that business too. And so you have the other firms talking up their trading business and talking up their Wall Street business because that's kind of what's in favor right now. And you have this weird thing where for years coming out of the financial crisis, say Bank of America which Brian Moynihan there talks about responsible growth, and he's kind of de-risked the bank. That has been a strong performer, and now Bank of America is it's a laggard. And Morgan Stanley too, with this very even approach with asset management, it also has its valuation has fallen as investors have kind of leaned into the more volatile and investment banking business because they think that's where the boom's coming.
And Liam, I'm curious to get your perspective on this because given what we're talking about, on the one hand, right, is very strong results, which would be potentially music to the ears of European banks, which have been doing better, and I would imagine would hope to continue to do that way. How should we think about the US and what that maybe is likely to imply for the Europeans that are coming out?
Yeah, so as you say, as of time of recording, the European bank earnings season hasn't really started yet, so it's all a sort of matter of looking forwards. But I mean, the big thing that has happened in European banking in the past sort of 6 months to a year, going back even 2 years, is that this basket case sector is no longer a basket case, basically. It used to be perennially, they would be valued at a big discount to the net value of their assets, the book value. That's really not the case anymore. On average, it trades a little bit above book value. They used to be just perpetually incapable of returning their own sort of cost of capital, if you want to think of it like that. If you think a bank should, return 10% as this kind of fairly random rule of thumb that a lot of investors use. Almost none of them did that for 15 years essentially since 2008. And then all of a sudden in the past couple of years, you've seen them do that. And to speak to the US comparison, I mean, what's interesting is that if you just take a list of a random list of big US banks and big European banks, and then you just sort from highest to lowest return, if you'd have done that 2 or 3 years ago, it would have been all of the American banks and then big gap, all of the European banks. If you do that now, it's just
and then Citi
banks.
at the bottom.
And then Citi at the bottom. Well, no, Citi was it was very familiar as a European banking. You'd look at that and you think, okay, yeah, I understand what that business is. It trades at a discount. It doesn't wash its face in terms of returns. It was, I mean, yeah. But now, as you say, Citi is right down in the mix there, trading at, I think it's re-rated a little bit under Jane Fraser, but the ranking now is I think you've got, BBVA, which is a big Spanish bank with Latin American operations. It's out returning, I think, most of the US banks, maybe not JP or Morgan Stanley. You've got CaixaBank, which is a big Spanish retail bank. Interestingly, some of the highest returning, highest value banks in Europe are from the countries that took bailouts after the Euro crisis. It's very weird.
I was just going to say, Liam, this for a US listener must be the most craziest thing to think about. And I know the 2008 financial crisis may seem like such a long time ago, but actually that is what people associate, right, Spanish banks with, is that, so many of them fell over. It was just, 25% youth unemployment. It was a really, really difficult. It's incredible to think that they're outperforming the US now.
Yeah. So go on, Stephen.
I wanted to say something about that, about the dynamic, because there's a weird thing going on now in the U.S. is that, as I said, Goldman is in favor more than Morgan Stanley, but Goldman's ROE is still lower. It's around 14. And there was a while ago, right after the financial crisis, where Goldman set up this thing where we're going to pay these big bonuses if we can get at least a 15 ROE. And people were like, wow, 15 ROE, that's nothing. Goldman hasn't been able to produce a 15 ROE since the financial crisis, at least dependably. And Morgan Stanley, even though it's out of favor, it's still in the high at 18, 19, right? And so I think that at least right now, there's a little bit of a disconnect. And Citi that we just talked about, they're still at around 8, they're still below that 10. And yet its stock price is going up and up. It's one of the best performers in this earnings season. So there's right now there's this disconnect that investors are sort of ignoring the returns, expecting that when this boom in M&A comes, it's lights out for Goldman and some others that have been laggards.
Do you think that, do the American bank CEOs, do they think their stock is overvalued? Because it's definitely European bank CEOs think American banks stock is overvalued.
No,
what do they think? I mean, no.
They think.
I've never met a CEO who thought their stock was overvalued.
No, they think stop talking about price to book. That's all lame.
Right.
Let's talk about price to earnings. Look at our stock price versus Google. Our stock price is so cheap. I mean, not quite like that. Alphabet, sorry. But yeah, that's what they want to say. Stop looking at price to book. That's old stuff. We're price to earnings.
Just to pull this all back, because, and I think to follow on a little bit from what Amy was saying here, we kind of all laugh because the most damning thing we can think about Citi is to compare it to a European bank. And when I hear you saying, Liam, that European banks are now ripping, it's I can't help but have a small alarm bell go off in my mind and think what has that historically been associated with? Because we have this moment, right, where we are genuinely in a high volatility moment. We are in a completely unprecedented economic regime change. It's not clear to me, it feels like the old narrative about we're trying to build out these more stable franchises. It makes a certain degree of sense, right? And yet you have all of these CEOs, I think, Stephen, when you and I were chatting, you kind of put it as they're tap dancing a little bit over the volatility, even while they gnash their teeth about it, right? Because all of a sudden they're look how valuable our franchise is. We can help you navigate all of these problems. But I just kind of wonder the degree to which anybody should be celebrating that right now. How much does all of this rest on a knife edge?
Let me make the positive case for my coverage banks, which is, having written nasty things about them relentlessly for the past 5 years, being critical, is let's be a bit more positive. What's the argument that Irish, Italian, Spanish banks should be valued at, multiples of book value? They're to Stephen's Wall Street, Main Street distinction, investment banking is the preserve of a relatively small number of big banks in Europe. And it's generally not the ones that are getting the highest multiples at the moment. The ones getting the highest multiples are like, oh, I understand your business. You do Spanish mortgages, which return 20% return on equity. And there's no way that, investors think there's no way that you're going to see a 2012 style Spanish mortgage crisis again, for various reasons, structural, economic. So I understand that return. I understand what Spanish GDP growth is going to be. It's pretty solid. It's not like a flame out M&A trading boom that, I can't predict. So I'm going to put a high multiple on that. The banks that are doing more kind of Wall Street stuff, Barclays, for example, they still get a lower multiple than, a retail bank, basically. So it's almost like the Main Street, Wall Street thing kind of maybe working the other way in Europe. I don't know what you think of that. That makes any sense.
So, yeah, I mean, I think that it's changing in the U.S. and I don't know if it'll change in the U.K. or in the Europe. But don't you think also there's the potential bonus of some kind of large M&A? You have Unicredit out there saying they're going to build a big, multinational U.S. competitor. I think isn't that fueling the European banks? The thought that maybe you would have a U.S. bank and they would get a U.S. competitor and then you re-rate everybody?
It's really interesting how investors think about M&A, how politicians think about M&A, and how CEOs think about M&A. That is, you're absolutely right to raise that. One of the massive strands of the European banking story at the moment. There's so many deals in the market. It feels like every week we do a European bank M&A story. But how many of them are actually happening at scale? So there's Unicredit, which is one of Italy's biggest banks, which has sought to buy Commerzbank, which is a big German bank. It's not happened. They've been trying to buy one of their own domestic rivals, Banco BPM. It's not happened. You've had Banco Monte dei Paschi di Siena's been trying to buy Mediobanca, another Italian bank deal. It's not happened yet. Might happen. You've got BBVA trying to buy Sabadell. It's not happened. So there's this theme of politicians constantly getting in the way of deals that CEOs think are necessary. So to your question, where does the market stand on that? Is that a source of the re-rating? Weirdly, investors seem to prefer buybacks to M&A, or they have kind of on the whole. When you saw BBVA announce its Sabadell deal, which the returns were pretty good, they said it was a 20% return deal, the share price went down. In a lot of cases, you've seen the share price go down when buyers have bid for an asset. So there's this kind of weird, tug of war, I guess, between the strands of that argument, where investors quite like the certainty of I understand you, just buy back your shares, keep doing what you're doing. Whereas CEOs are like, we're going to fix this subscale, fragmented European banking landscape.
Yeah. So maybe I can tie this back to the U.S. stuff. Is that investors right now, perhaps wrongly, are leaning over the edge in both sides. They're both in the U.S. they're saying, yeah, you haven't shown me that trading and investment banking can produce high returns, but I know that's coming. And yeah, you haven't shown me that you can actually build a pan-European bank, but I know that's coming. And investors in the financial sector right now are leaning over that edge. And I think that's where maybe we have problems.
But I think, though, I sort of wonder whether they're both wrong, right? Because to the point about M&A in Europe, Liam, my understanding is that whenever you try and merge two big banks together, what you often get is the unions getting involved. They don't want job cuts, which sort of removes a lot of the synergies. In Spain, you have the government that is actively trying to sort of block a big deal from happening. And then to your point as well, Stephen, in the US, it's it seems what people are excited about, things like credit and, sort of M&A, it seems so divorced from what's going on or likely to happen in the economy, right? So you've got tariffs that really haven't even kicked in yet. Is that, Stephen, I guess I'll go to you on this, is that something that could derail this kind of excitement in Wall Street about that is, that people actually may not be able to pay their loans, that non-performing loans would go up, that all of these things would just actually start happening in the real economy? And this excitement does not really make sense. Right.
Yeah. I mean, you can't have for an extended period of time, you can't have the clients, the main clients, which are the companies borrowing and expanding or the companies doing deals, living in uncertainty, but the Wall Streeters feasting on it, right? I mean, eventually you've got to have the underlying activity. And if this strains smaller or mid-sized companies because they're not sure what they're doing, or they have to pay more for their supplies, or their customers don't want to spend because they're not. Eventually, that's the bedrock of the business has got to. If that crumbles, then the rest of it that's built on top falls too. But for the time being, credit's been good. People are spending, and so the rest of the stuff can keep building on top. That's the beauty of the leverage that builds. You can add on top to get more trading and to get more. And there's a myth right now that this stuff has become trading and lending to private credit firms and doing private credit themselves, that this stuff is stable. But Wall Street, Goldman wants to call it dependable. Come on.
Well, this is the thing. I maybe want to close out here by asking you both, what would change your view on this? Because I know, so I cover the alts managers here at Breaking Views, so I do a lot of private credit coverage, and I don't know, maybe I'm suffering from Stockholm syndrome here at the moment. But even Jamie Dimon, the kind of king of criticizing private credit and I mean credit in general right now, is desperate to get his traders into that business. Is desperate A, to trade the underlying credits, B, to provide leverage kind of around this stuff. And you look at this thing, and it's we've been reading, I think, various outlets have called the last 12 deaths of direct lending. And yet all of this keeps building up. It really does seem like there's a meaningful retrenching of the banking system. What would make you believe that there is something to the idea that leaning into this Wall Street side is more durable, just because credit creation has moved elsewhere in the economy?
You can't. I don't think you can. I don't know how you would convince me. But if you say, okay, trading, the revenue I get from trading with people is volatile, but if I lend them more money to trade, then that lending is a durable business. How is that possible, right? But I think the cynical take here about Jamie Dimon and the rest of Wall Street right now, because David Solomon at Goldman said, these are interesting times. These are interesting, exciting times. Yeah, exciting for you. But so the cynical take is that this works for the banks. It works for their clients to be in disarray, or their opinion of the future to be uncertain, because they can make money off that uncertainty. So you have Jamie Dimon out there saying, hey, I'm really worried about all these risks, and I'm really worried about uncertainty. And aren't you uncertain too? And that drives more business for himself. That it's self-serving for him to be this continual worry ward.
Right. I mean, I guess, Liam, to kind of pose the flip side to you, because it sounds like what you're saying is the European dynamic is somewhat of a mirror image of this thing. When I hear about, people have a feeling that they understand the modeled out returns of the Spanish mortgage market, I just my eyes bug out of my head a little bit. Is there anything there that you would be looking at among all of these franchises to think there is some sort of correlated systemic risk bubbling up in the European financial sector? Because it feels like a lot of the commentary has revolved around the sort of center of gravity in New York, and I don't have a good sense of kind of where people might even get over their skis on the European side.
I think, it depends on the names. I mean, if you're just talking about the kind of the classic banking, credit cards, mortgages, stuff like that, the real and most obvious risk is that Europe goes back to being Europe in terms of rates, right? That we're not a 2 to 3% interest rate region, we're a 0 to 1%, and some combination of low growth and low productivity and low bad demographics just plays out. And then everything that was true becomes true again. And this weird moment where you can be extremely profitable just by having, some deposits and then some Spanish mortgages or Spanish government bonds on the other side of the balance sheet. That's not true anymore. That becomes a losing proposition, as it was for most of my professional life. But in terms of the more interesting, kind of, how are people gonna, what's the hidden risk? I mean, there's a bunch of areas to look at, and I actually don't think they're so different to the Wall Street stuff, right? I mean, people talk about private credit a lot. I mean, my understanding is that this financing business within the trading stuff, the real growth area, most of the balances, it's hedge funds, right? It's prime brokerage, it's repo, it's you're lending to big multi-strat shops. It's everyone's forgotten that Archegos happened. This really wasn't that long ago that the street took 10 billion, 12 billion of collective losses on this one guy who wasn't even a hedge fund. It was a family office. Imagine if something happens to one of the big pod shops. Imagine if something happens to Millennium Sister. I mean, I don't know. They seem like pretty well run places, but I don't know how you can possibly rule that out. And everyone on Wall Street, and it's the same in the City of London, it's the same in Frankfurt, is saying our trading businesses are now financing businesses. Who are you financing? When was the last time that we went 10 years without a big hedge fund exploding? I don't remember that ever happening. So
Yeah.
I don't really get that whole thing. It's more durable on a quarter-to-quarter basis, obviously. It's a higher returning activity potentially, but it doesn't make me feel great about the state of the system, if you know what I mean.
The model engraving on every tombstone of every bank run. I'm hearing a pod blew up. All right. Okay. I think thinking about when the gravity might turn back on is a good place to leave it. Liam, Stephen, thank you so much for joining us on the Viewsroom.
Thank you.
Cheers.
Thanks for tuning in. This podcast was produced by Cheryl Pena in New York and Gregory Garner in Toronto. You can listen to a new episode of the Viewsroom every Thursday on the Reuters app or your favorite platform. And don't forget to tune into our sister podcast, The Big View, every Tuesday, as well as the other great podcasts from the Reuters team. If you like what you heard, please follow the Viewsroom and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.